Okay, Bismillah Rahman Rahim. Assalamu alaikum once again. Advanced Financial Management Bootcamp Day 2. And today's particular agenda, focus agenda is about to discuss a quick review, to make a quick review about two topics. That's international investment appraisal, number one. And number two, we will work out with a question called Washi Company, September 2018. Before starting this particular revision of the sessions, very important thing is that during the revision days, you people can use this document as a benchmark. You can use that particular questions as a benchmark questions. For example, Washi Company, Okan, Colvin, Gorath, Bolian, Edvarna, CMC Specimen 1. These are what the benchmark questions that you must have to attempt as exam simulation. Moreover, I strongly suggest to you that you people must have to cover the Kaplan chapter number 3 for international operations and international investment appraisal. That's a very key point. Furthermore, you can use my notes, the treasury management that I have already shared you with a folder of pocket notes. You can use that particular notes as a pocket notes for the treasury management. So now we are going to start a quick revision. Quick revision. One moment. Quick revision about the topic international investment appraisal. So what a quick review you have to develop, you have to recall the things from your mind that international investment appraisal, if we are work out for the calculation matter, primarily the question is about appraise the foreign investment. And the appraisal can be made, number one, by NPV method, or number two, by APV method. Both the method can be used. Very basic. NPV method. NPV method. Number one, the very first thing to recall the things accordingly, let's make an assumption. For example, locally based on, for example, UK, and international investment with, for example, Turkey. Your local currency is sterling, and here lira. The very important thing you need to consider, sorry, And for the working, we need to consider that, first of all, the very first thing you have to recall, the very first thing, to calculate the NPV, the supportive workings. The supportive working. Number one, you people must have good enough knowledge about the exchange rate. The exchange rate estimations. It's by purchasing power parity theory or interest rate parity theory, where estimated spot is equal to spot now multiply by 1 plus inflation A divided by 1 plus inflation B. Mark my word that whenever you calculate the estimated spot, you never ever consider the code is direct code or indirect code. Don't be confused. Don't ever confuse the direct code or indirect code. Don't ever confuse the direct code or indirect code. If a spot rate given, for example, sterling over Turkey, sterling over lira. So numerator of inflation, sterling, and denominator of inflation, lira. And if the rate given lira over sterling, then vice versa. And that is what purchasing power parity theory. If you work out with the interest rate parity theory, it all depends the availability of the question. Replace inflation with interest. That's all. The first thing, exchange rate estimations. Number two, the WAC complications. The WAC complications like K, KD, beta asset, beta equity, all these things are same. Number three, some specific issues. You have to consider that. For example, bilateral tax treaty. Bilateral tax treaty. Bilateral tax treaty means a very simple. For example, local tax rate is greater than foreign tax rate. We have to pay the extra tax with local currency. For example, in UK, the tax rate 40%. In UK, the tax rate 40% and the local one. And the Turkey, the tax rate 30%. So we have the bilateral treaty exists between two countries. That if with the Turkey we have already paid 30%, and we come up and take the remittance to the UK base, then UK tax authority will charge extra 10%. The 30 will be waived. The 30 will be waived. That's the point. Number two, if the other case less than or equal to foreign tax rate, no extra tax. Simple bilateral tax treaty. One more thing, that's called tax holidays. You have to consider. Sometimes if you go for the foreign investment, there is an opportunity about there is some opportunity with respect to incentives with foreign investment, FI foreign investment, like tax holidays. Government will allow you to make some tax holidays. The first thing, number one. Number two, furthermore, may be possible the government grants. That is a point. Okay, further, the complications, further complications, the complications about intercompany transfers of material or services. So is it in this case, there's a possibility that a UK based company charge some amount to the foreign investment into Turkey, charge some amount, charge in the term to provide the material to the another country, to the Turkey, or the service charges. So number one, that is the cost for foreign investment, and that is the inflow. Cost here means the outflow for foreign investment, and here the income, inflow, but here inflow, so-called contribution for local currency, with local currency. So that's the key point. Intercompany transfer, that possibility. And of course, with this scenario, local tax implications as well. Local tax implications as well. You have to pay the local tax for the UK based. For example, UK, the tax at 40%, you have to pay full. Furthermore, a very tricky aspect, that's extra tax payments in case the local tax rate is greater than foreign tax rate. Here are some complications. What are the complications? Do remember that these are some steps of the working. First of all, we have to identify that the taxable income, with foreign currency. Do remember that, mark my word, never apply the extra tax with the remittance from the foreign country. No, whatever the taxable income we earn with the foreign currency, and we apply the tax. For example, at Turkey, whatever the taxable income we earn with the Turkish lira, we have to apply a rate 30%, but in Turkish lira. So for locally, we have to pay in sterling the extra tax. First of all, determine taxable income foreign currency. Then convert in local currency. Convert in local currency. The above step means whatever the taxable income with the foreign currency, you have to convert into the local currency and then apply the extra tax. The extra tax. For example, UK 40 minus Turkey 30 is equal to 10%. Moreover, timing of the cash flows is also important. Timing of the cash flows is also important. Your final NPV must be with local currency. Here the case sterling. That is the point about the NPV point. That is the point of the NPV point. But do remember that you have to read the book about more details. For example, foreign investment categories. Foreign investment categories in terms of direct investment, in terms of export, in terms of licensing, in terms of franchises. You have to read it. Moreover, this is what about the investment appraisal? What about the financing structure? Finance may be funded. Finance may be funded through the supports of the World Bank, supports of the IMF, Asian Development Banks, and others. Must have to read it. Must have to read it. So that's why book reading is very much important with this case. Sir, you said earlier, can you please reply me? Are you people with me? And can you please reply me? Is that supportive for you for these discussion? If not, I'm going to start the question directly. Number two, the another important point. The another important point. The APV. Sir, what if the case about the APV of foreign investment? Don't worry about that. Foreign investment and APV. First of all, we have to work out base case NPV. What does that mean? Base case NPV means take out the operating cash flows. Operating cash flows. Take out the operating cash flows. Operating cash flows in terms of foreign currency. That's all. Operating cash flows means we are at UK and we have investment opportunity in Turkey, but with that investment, finance will arrange in a manner our capital structure will change. If our capital structure will change, if our capital structure will change, if our capital structure will change, then our analysis appraisal method become change. But the main operating cash flow structures are remain same. So first of all, identify the operating cash flows. Operating cash flows in terms of foreign currency. Operating cash flows, contribution, tax payments in the foreign currency, all these things. Candidates, one moment please. I want to take one important call. Operating cash flows in terms of foreign currency, number one. Number two, KE ungeared. KE ungeared. No complications. Because KE means discount rate. Because KE means discounted, and here we need to get the discounted with our own, with our local method. Same as NPV. Or I can mention no extra complications. Two methods, CAPM or proposition 2. Number one. Number two, financing side effects. Financing side effects. Here, very much important thing. The question is that the debt finance, either local or international. In case of local, no extra complications. What does that mean? You people know very well, financing side effects includes three things. Number one, issue cost. Number two, tax shield, as we discussed already. Number four, subsidized loan. What I am trying to say here, if you are UK based company, you're locally UK, and assume that your debt finance, you arrange the debt finance locally. No extra complications. Like you normally do, whatever you normally do for the APV, calculation for the financing side effects, all these things, same as it is. But what if we are local company, but on the other hand, we are a local company, but on the other hand, we are going to invest Turkey, and we have decided to arrange the loan at a Turkey. At Turkey. So that's required some complications. What complications? For example, if we arrange or issue the debts at Turkey, then issue cost, we have to convert the issue cost into local currency. Number one. Number two, tax shield. Think about it. Think about it. Tax shield with the international matter. Number one, debts multiply by interest rate, multiply by tax rate. Whatever the amount, this amount is tax shield based on foreign currency. So that need to convert that foreign currency cash flow, convert with local currency here. And then using discounted, KD or RF. So one step here more. That tax you will first need to convert with the local currency. That's important. Same case, subsidized loan. We go to the Turkey and they have provided us the subsidized loan. So subsidized loan multiply by SR subsidized rate. SR subsidized rate multiply by 1 minus tax is equal to foreign currency cash flows. Then convert with local currency and then using discount rate, either KD or RF. That is the complication if debts arranged internationally. That is the point. That is the point. So this is what a quick calculation mode matter about APV and NPV by international investment. Moreover, about the report writing, the structure of the report writing as we discussed earlier. About the material of the report depends on the question. Two things. More things about foreign investment matters. I've already told you to refer the book with the chapters. So this is what about the foreign investment, a quick review. Number 2, risk management, Forex. The topics Forex, risk management, Forex. One of the important topic of the course that is about the Forex as a risk management. You people will first of all have a good command with respect to the theory with these things. Good command. Number 1, why Forex risk arises. You have a good command for the explanation about the transaction risk. Means the companies involved day-to-day transaction, either short-term or long-term, that face the risk in terms of appreciation of the foreign currency or the depreciation of the foreign currency, depends in the payment or the receipts. Number 2, you have good command related to translation risk. If we have investment in terms of foreign subsidy or in terms of assets, so this is not the realizable risk, but the risk that could affect to our financial statement by the translation of foreign subsidy or the foreign assets. That is called translation risk. But this is not enough. What I am saying, you have a good command to write it accordingly. Translation risk. Economic risk, because examiners sometimes examine the things 4 to 5 marks independently. With the case, what is this about? Explain this matter. So you have a good command. Economic risk, the macroeconomic activities, whatever the macroeconomic activities the company, if the company faces the risk related to macroeconomic issues, either locally or internationally. For example, locally government policy affect the inflation rates, affects to the exchange rates, reason of the monetary policy. That will impact to the businesses. This is about the local. Sometimes it affects, it may create the risk related to the foreign matter. For example, you are Turkey, but some arrangements made by the America with other countries, due to that reason, the appreciation in the dollars hit to the local currency of uh, Turkey. So that is out of the range. That's called the economic risk. So you have to good command for the explanation. Moreover, hedging. You should have a good command related to internal. Means you must have to know what is the meaning of currency invoice. You must have to know about netting. You must have to know about multi-netting. You must have to know good about leading and lagging and external. Forward. Yes, calculation required futures, options, OTC, options, tradable. Money market. Sir, do we have a good command with respect to the calculation aspect? Yes, good command with respect to the calculation aspects, but also for the theoretical aspect about the external. But the theoretical aspect is about comparison. How to compare with forward with futures, how to compare with futures with options. For example, the comparison with forward with futures like this. With the forward, for example, it's more beneficial forward in the monetary terms. For example, payment with lesser payment as compared to the futures with the calculation. But on the other hand, the theoretical side is that the chances of defaults with the forward is higher as compared to the futures, because bank having a chance to default, but futures is actually backed by or supported by the government, because market supported by the government, there's a leg chances about the defaults. But on the other hand, futures having the complications about having the structure about initial payments of the margins, although it's adjustable, but initial payment of the markets, and futures having the tax consequences from the markets like the stock markets. So you have a good command for the explanation between forward futures. Same case, the comparison between options versus futures. One important thing before options, option OTC, and you people know that forward is also OTC. Either options OTC or forward OTC. Sometime examiner examine the difference between over the counter contracts, either forward or options, versus marketable. By the way, money market also OTC. Huh? So OTC having benefit and drawbacks, customized benefit. But chances of defaults, it's a drawback. Okay, leave that matter, OTC versus market. Futures versus options. All the option contract, either OTC or tradable. With the option contract, drawback is premium. It's a sunk cost, it's investment. But the benefit, if we engage with the option contract, we will be able to get the benefit of favorable positions. That is the benefit of options. As compared to this, if we involve with the future contract, although the things are predetermined, are predictable. Futures, the things are predictable, predetermined. But at the time of favorable situation, we have to ignore that point. That's the point. Candidates, can you please reply me? Is my voice clear to all of you? Now, candidates, I strongly suggest that one of the important function that's called treasury function. One of the important function that is called treasury function. Treasury function role related to Forex, related to interest and other matters. You have to refer my pocket notes about the treasury management. You have to refer my pocket notes. I've already granted you the access through the G drive of the all pocket notes of the course. So you can refer that point. Now come on. Next point. Next point is question. Next point is question. Washi is September 2018 question. And this is a very good question, a 50 marks question. Oh, sorry. My mistake. One moment. Sorry, practice question 1. AFM practice question 1. Actually, this is what about? A question Washi. So, candidates, today we have to attempt that particular question that's called Washi company. Are you people ready? The Washi company question. So I strongly suggest you have to open the My ACC aspects with your own. That's very much important. Okay, come on.